Welcome to the SaaS Revolution Show, a podcast by SaaStock. Here we interview SaaS founders from around the world who've been there and done that, as they share the ins and outs of how they built their businesses, their operations, their path to securing investment, and more. Our mission with the podcast is to help you, the founder, learn how to scale your SaaS, maintain your well-being, and navigate the complexities of this ever-changing industry. I'm your host, Alex Theuma, and together we'll explore the good, the bad, and the ugly in the journey to SaaS success. Welcome back to the SaaS Revolution Show. I'm your host, Alex Theuma, CEO and founder of SaaStock. Delighted to be joined today by Tim Schumacher, one of the founders of SaaS Group. Welcome, Tim. How are you doing?
Good. How are you? Thanks for having me.
Yeah, very good. Very good. Been a busy couple of weeks, and I'm looking forward to, we're at I guess the start of summer. Although it's going to be, I think, the wettest summer in 100 years in the UK. So perhaps less looking forward to that, but that might help with some productivity potentially.
True.
And how are things? Whereabouts are you at the moment?
So I'm based out of Cologne, Germany, but SaaS Group is completely remote. So we're literally all over the place. Lots of people in Europe, Western Europe, Eastern Europe, quite a few people in the US, but also in many other parts of the world.
Does that make it a lot of travel for you, or do you guys just get together centrally like every now and then?
So we get together once a year for our big SaaS grouping. We have some separate meetings as well for leadership, but most of the time we actually do things remotely, and it's a blessing and a curse. So no, we don't travel that much for one, because it's quite a bit productivity killer. Also, I'm always quite concerned about the carbon footprint of things. You mentioned the wettest summer in the UK.
Yeah.
There's a reason for that. That is climate change. The wet weather extremes are becoming more and more frequent. In some areas, droughts. In other areas, floodings, like we had in Germany last week. And so it's we're trying to keep the carbon footprint low. So that's the other motivation.
Yeah, no, it's definitely a good motivation. Well, Tim, look, I always start the show getting to know the guests a little bit more. So we'd love to know, in your words, who is Tim Schumacher?
So I'm an entrepreneur. I'm a software entrepreneur. Been a software entrepreneur almost like I was like 14, 15 years old. Got my first computer, started coding. Coded kind of the first 10 years after that. Computer games, websites, all sorts of things. Had a somewhat modest success, or for our age, I think it was quite cool with a football manager, which we licensed to Bayern Munich and Borussia Dortmund and the likes. So it was actually quite cool. Still kind of a disc-based or CD-ROM based product. And then went on, studied business, kind of faded out a little bit from the computer science part. Stopped coding when I was like 25, but did this quite a bit before. And started Sedo, a domain marketplace, which I ran for 10 years as the CEO. Grew it from 3 friends in a garage to later 300 people. Took it public, ultimately sold it to United Internet, big hosting company. And then after retiring from Sedo, dabbled around with angel investments, had some cool investments where I also became operatively involved. Ecosia.org, some people might know the green search engine. It's a nonprofit now, but largest planter of trees in the world. And then AdBlock and AdBlock Plus, the big ad blockers, is a company I still am the main owner of that, and lots of angel investments before then starting SaaS Group 6 years ago, because I really like the entrepreneurial energy of SaaS founders, and there's so many great SaaS products around, and I wanted to help kind of with my scale-up skills. I wanted to help build a community of independent SaaS products, and that's what I've been doing for the last 6 years.
Awesome. Just on angel investing, so like a lot of founders that have had exits like yourself, they start to dabble in angel investing. it doesn't always go well, right? Obviously it's pretty difficult, right? And especially at that early stage, often there's not a lot of traction and kind of like metrics to kind of base your decisions on. What are your thoughts? Like you did it for 6 years, like maybe like sort of key learnings. What were you looking for in an investment? In a fundable founder.
Yeah, so I was doing super early investments, and usually the founder and the founding team is key. Like the first thing is I got to relate to that person. I need to believe that he or she is really the right person or the right team to grow a company. And of course, I try to use some early indicators, kind of what traction do they have, how much money do they need to get to this traction. I mean, it's obviously a big difference whether you reach, I don't know, $500,000 in revenue with no funding, or whether you've burned through 2 million to reach that. Tells me something about capital efficiency, about scrappiness of founders. I have to like and relate to the product. Something where I'm like, best thing is always, I want to be a customer myself. Then there's a good likelihood that some other businesses or consumers have the same issue, wanting to become a customer. So that kind of dog fooding of products, I'm a big believer in. But yeah, at the end of the day, it's really a gut feeling about the team. And I've had some great successes, but also I've been terribly wrong multiple times. It's very, very hard to predict. And that also, I mean, I'm still doing angel investments. It's fun. It's working with some great founders. But I think for most entrepreneurs like myself, the frustrating thing is that you can't really influence things. You give someone money and founders are great or they aren't, but it's not your business. And that's the way it should be. The founders should run the show. And that was also one of the reasons which let me start SaaS Group, because SaaS Group, we get deeply operationally involved. We see a lot of benchmarks across the various companies, so it's something where we can actually really change the course of companies to the better. And that's, to me, it's much more motivating than just keeping people.
So it's a nice segue. So obviously 6 years ago, I think you said you started SaaS Group after this period of angel investing. And the angel investing, certainly helped you move into deciding to start SaaS Group. So tell us a little bit about the founding story. Obviously, I'm assuming that you're not doing this on your own. Why decide to do it when you did it, and how did it all come together?
Yeah, so first project was really just acquiring a project called Deploybot, which we still own, deploybot.com. It came through FE International. I was like, wow, this is a very reasonable price. This is a nice tool. Let's buy it. And I did that, took it over. It was an interesting transition because it was literally, it was a spin-off from not a large company, but a company with a couple dozen people and some other products who wanted to streamline their product offerings. And it was like, okay, here are the keys. Within 4 weeks, you're going to have your own developer and you take this over. So super short transition period. And then after 4 weeks, I had found an agency to do this. And so the first thing is like, hey, they managed this. And I was basically just collecting the monthly dividends. So it was really kind of this passive income idea at first. And it worked well. And I asked then my CDO co-founder, Ulrich, to join me, which he luckily did. And we were like, hey, let's make this a little bigger. Let's buy the second project, which was Juicer, then the third one, fourth, fifth, and so on. And at some point, we kind of had this flywheel is, okay, we know what to look for. We know what makes a good project. And we see the levers on how to improve things, actually developing some sort of blueprint. And then kind of fast forward to about 3 years ago when we started to hire a great M&A team, great central teams that help doing those things which before Ulrich, I, and then later Toby, the CTO, did, but do it in a more kind of systematic fashion, really taking companies to the next level. But the original idea was always like, okay, what's out there? What are great projects that are worth preserving, worth taking to the next level? Because for a founder, like, if you sell your business, that's like selling your baby, and and you want to see it in good hands, and we're trying to provide this. And we've had cases where the founders stayed on board. We've had cases where the founders left very quickly. So I think we try to do what's best for the founder and suits his or her lifestyle, and we can work with either scenario.
What data can you share about the company to give paints a full picture to the audience?
Yeah, sure. So we have acquired roughly 20 companies, 20 SaaS companies, all of them in the range between usually 1 to 10 million AR, or 1 to 5 is really kind of our sweet spot. We had one project which was smaller when we acquired it, or two projects, DeployBot and Rewardful, the affiliate platform. And we had one which was a little bigger, but most of those are in the size 1 to 5 million. By now, some are actually in the 10 million range ARR. The entire group is a bit above 50 million revenues these days. With 300 people. Out of those 300 people, the vast majority, so more than 80%, work in the brands, but then about 20% are in the supporting central teams. And yeah, globally distributed, and those, I would say, are the big facts about SaaS Group.
What is it like to have this company, SaaS Group with 20 SaaS companies, within that? Can you share a little bit more about that? And also, I think, some of the common things that you see perhaps across that to kind of, as you say, like help the companies grow, maybe some of the common challenges, but what's getting them to grow from, perhaps when you take them from 5, to 10 and whatever that time frame is?
Yeah, so that's a great question. Every company is unique, but if I can group that into two scenarios, I think we're seeing two types. One is, and that's what we started with, the companies who are really super small, bootstrap DNA, very frugal founders. Sometimes we had companies where there was just 1 or 2 people. Like Pre-Render, for example. We bought Pre-Render, a JavaScript pre-rendering tool. It was one developer when we bought it, one support person, and now it's 5 times the revenue compared to when we bought it, but it's also a team of 20 people. So very often it's really about taking those first steps from making the founder redundant in a good way, because of course the founder was a super brilliant guy, but also every founder has usually 1 or 2 things she does really well. But in this case, it was the product was top notch, but we needed to develop a proper onboarding process, a proper website, support customer success. None of that marketing, none of that was existent. So we really kind of staffing all of those positions one after the other to really make this a team and make it grow. And in this case, it worked really well. It doesn't always work as easily, but in most cases, it works quite well. And then we have a second bucket, which is a bit more recent. For the last 2 or 3 years, when a lot of founders were struggling, we saw a lot of businesses which either went into bankruptcy, that's the most brutal case, but also some others where the founders just wasn't going anywhere with the VC money. So they took VC money, VCs then lose interest in a company, but they also at some point want their money back, but they're like, hey, we kind of have written off this company, but a lot of companies are actually great companies. They're doing 2 or 3 million revenues. For a VC, that's nothing, but that's just not fair, because it's like, those are good companies. And we kind of reset them to the bootstrapping DNA. That's how we think it is. Like a lot of companies which are bootstrappers, then they get money. Some make it, but a lot of them actually, they just burn through the money and they're still on the same growth trajectory as bootstrappers. And they should have never been a VC company in the first place. And we kind of reboot them to this bootstrapper DNA. We've had a few cases in our portfolio, bcast.com, for example, Costalon, Zenloop. And that has been working quite well because it makes companies quite healthy again. Money can be good for obviously, like a lot of founders want an investment, but money can also be ruining a lot of things, and we, by resetting this, we actually make the companies and then kind of grow it from there. But it's very different work because it's almost like restructuring, or it is restructuring work, but kind of for the better, and then building it up again. So we really have those two buckets on how we work with companies.
No, it's interesting to hear that, and obviously see this as an option for certainly like VC companies that, as you say, should never have taken that money. I won't name names, but I read an article sort of yesterday from a well-known VC, and I think within the article, he kind of mentions that perhaps sort of similar to this example, that certain companies, they get to 20 people companies, they're profitable, but then at that stage they're just kind of not growing,
right?
Where the VC wants to get them to be this $1 billion company. And his perspective was that they should just, rather than pivot or whatever, that they should just die effectively, right, and focus on something else, right? I thought it was an interesting perspective. I kind of got it. Like, obviously they're giving them money, and with that, the initial kind of ambition of like, okay, this is going to become $1 billion company. But when they see that it's not going to become that, his perspective was that, well, it should just shut down, and then the founders could go somewhere else. But here, what we're seeing is that there is actually another option, that they're you could have a good business, but it's just not growing in that hyper growth trajectory that a VC would expect will not get that next funding round.
Exactly.
Therefore, with a good product, with a good business, with a good team, there is another path.
Yeah, absolutely. And sure, if startups are pre-revenue, then it's easy to die. But if you have paying customers paying $2-3 million, that's a shame. It's also it's a product which serves a need, which has product market fit, and then in our opinion, they shouldn't die. So yeah, to all VCs listening, if you have those projects in your portfolio, contact us, because we think it's a soft landing. The VCs get some money back. It also looks much better for the founders on their CV. It's a great new home to the team and the customers. So I think it's just the much more sustainable way of dealing with companies that aren't meeting the stratospheric VC expectations.
I want to talk about exiting your SaaS business, and given you exited your own business, prior to SaaS Group, given that you've obviously had the experience of like 20 M&A deals, and obviously this continues to grow. And I think also, like, very timely, I had a lot of conversations, and again, not naming names, but within the SaaStock community this year, also connected to a lot of founders. And I was really surprised, perhaps for the first time in the 9 years that I've been doing SaaStock, about how many are really looking at M&A, thinking about selling their business, after maybe running it for 3 years or 5 years, and they're doing what seems to be, my opinion, like pretty well. And again, like perhaps talking a lot about mostly some bootstrappers here, but companies that are at 7 million in revenue, 5 million in revenue, 8 million in revenue after just a few years, right? And my thoughts were always that and maybe this is biased from my own experience, that I think, it should be like at least a 10-year journey. And, like perhaps if you're thinking about selling after year 3, of course, everyone's going to have their own kind of like personal reasons. But whenever I've kind of had conversations, with such individuals, and like, surely it's too soon. You've got something there. Why not, give it a lot more? But I think there are a lot of factors as to why people consider selling their business, right?
Absolutely. Yeah.
And so, yeah, I want to dive into this and lean on your expertise and what you see, because I think it's seemingly a very interesting topic right now about exiting your SaaS business. So you're happy to kind of dive into that?
Yeah, totally. And I think, you already started with the most important question, the personal motivation. It's also always one of the first questions I ask when I get to know a founder who wants to sell, is like, why do you want to sell? And I don't want to hear the glossy, polished answer brokers give. I want to hear the true personal reasons. And there's no right or wrong. I think every reason is very legit, and it usually comes after quite a bit of soul searching. We've had founders who are simply burned out. We've had founders who just don't enjoy running a company with all the managing people and the nitty-gritty stuff which comes with it, but who actually like to just build products. We have founders that run a company that is successful in revenue, but it's not super profitable or not profitable at all. And at some point, they want to take some chips off the table because as a founder, you have all your eggs in one basket. We all know how industries shift, how AI can disrupt companies as well. You might have something now which is worth millions just to see it crumble when there's some new development, and that makes people nervous. And I think rightly so, because I think there's one thing I learned over and over again working with founders who've exited is there's a diminishing return of money. It makes a big difference for a founder whether you make $1 million or $5 million after an exit. That really changed your life. The difference between that and 10 million is fairly small. Let's face it, it's not that big. And yes, for the VCs, because they need the fund returners, they keep pushing. That's also the narrative a lot of people are pushed to, but it does make a lot of sense to actually make a cut, sell, and then move to the next topic. And then you can also be more relaxed and really swing for the fences and for the big exit. But we see a lot of founders who also get risk averse after some time because they're like, oh, I've created this. It makes a few million. I better not screw it up. And it makes them more nervous and more risk averse than they should be. And then often there are also personal reasons. People want to spend more time with the family, or there are two founders and one wants to do something completely different, or they get in a fight. So there are lots of different good and bad reasons, but all the reasons are legit. And I think it's really important that the founders do some soul searching and think about why they really want to sell. And that's honestly reflected also then in the process, and also then kind of governing some of the terms. So for example, how long do you want to commit? Do you want to commit for a short transition period? Do you want to commit for 1, 2, 3 years? That of course also changes the economics of the deal.
You mentioned the glossy answers that brokers sort of give when they perhaps present you with an opportunity. What are, like, when you actually speak to the founder and you like the look of the opportunity, you mentioned, I guess, kind of like there's multiple reasons and they're often very personal. Are there any bad reasons that when you speak to the founder, that you'd say, okay, well, we're going to avoid this, or like any bad answers, and hopefully maybe this might be helpful.
Okay. Well, there's one bad answer, but that one a founder will never give. It's, I have this real risk in my business. So I see this development in my industry, and obviously the founder knows the industry best. And for that reason, I think my business will tank in the next year. So that risk is that, but that's our job to find this out in the DD. I think a founder should fairly mention the risk, but of course no one will say, okay, I really know this business will tank. If that exists, then those businesses are usually selling for cheap. So I'll give you a practical example. So we looked at, for a while, we looked at some businesses which were doing automated marketing on Twitter with like fake likes and all those things. And it was kind of obvious all the founders wanted to sell because Twitter was cranking down on API access and those sorts of things. And it was very obvious. And they all said, no, I want to pursue a different career or something. And that's, of course, bullshit. Yeah. But also those businesses were selling very cheap for a reason. And sometimes you like their risk, which they are, and we can accept them as a portfolio company. So I'll give you another example for this. When we bought Pre-Render, the JavaScript pre-rendering tool, we were very concerned with the risk that the way Google indexes pages is less dependent on pre-rendering, but will be database driven. And there's been some debates around this. And so it was a known risk, and we debated whether we should do the acquisition. It was one of the most successful acquisitions we ever did. It is still a risk, but we can live with it at SaaS Group because we have 20 companies. So if one doesn't go that well, it's not existential for us. For a founder, it's existential because he had all his eggs in one basket, pre-render. So very often the transaction can make sense because risk is more palatable on the side of the portfolio.
Makes sense. What are the key steps involved with acquisitions? Can you talk us through that?
Yeah, sure. So, I mean, the first step is really thinking and doing the soul searching period. And that can be quick, but it can also be taking years. We have founders who take years to take their time and think about this. What do they want to do next? And are they ready to sell? And that's okay. But that I would say is the first phase. But then kind of the process usually starts with that phase when founder decides, okay, I want to sell. I want to either engage a broker, or I want to now talk to all the people who wrote me emails over the past months or years. And by the way, I recommend every founder, you get a lot of those inquiries, answer with a standard email, keep the data of those people because you might need it 2-3 years down the road. And it starts with this, okay, I'm going to put together some information, maybe a little data room, and I'm going to reach out to people who want to buy me, either directly or through a broker. And from this period, I would say is about maybe 2 months period. You know, you solicit offers, you get people comfortable with it, or have your broker do this, and then and that's the time when actually then you probably will get some sort of LOI, a letter of intent. I wanna buy you, and to which terms. And then that's the part when actually, you need to make a decision whether you want to go with this party. In our case, we view an LOI as something like a handshake agreement. So something which we really want to stick unless, we find some problems during the DD phase. The LOI phase then kicks off the DD phase, which stands for due diligence, where really the acquirer really looks through all the data, looks through team data, customer data, does a technical diligence. Is the code garbage or is it well documented? Those sorts of things. Customer reference calls, and at the end of this process, you start negotiating the contracts for that. That's probably another 1 to 2 months. So the whole process, kind of from the initial phase, you should look at anything from kind of 3 months at best to probably 5-6 months if it's a bigger deal.
Would you ever recommend that a founder goes without a broker? For instance, I think, correcting this, that Profitwell sold to Paddle. Patrick Campbell didn't use a broker. He had legal support, but he didn't use a broker. He obviously had a pre-existing relationship with Paddle, and is a smart guy. And he got a $200 million deal, which I don't know whether that was kind of like a 10x or like multiple. But I guess founders can be confident, right? And perhaps they think, I can do this in themselves. But like, what's your thoughts around that? Like, to use a broker or
Yeah. Well, it depends a lot. I think if you have this one buyer where it's like the perfect symbiotic relationship, and that one, like in the Paddle Profitwell example, and then I think it makes a lot of sense to go without the broker, just have an advisor, because the broker actually just adds noise to the process, and no one would have paid more than Paddle in this case, because it was just such a perfect fit. We've done a lot of great deals without brokers, but we've also done some great deals with brokers. If you really don't feel comfortable with this process, I think you should engage a broker. Also, if there are a lot of stakeholders to navigate, and you really don't know who your buyers are, then it's much better to have a broker. But very often you also have a pre-existing relationship with someone you are happy with. You might get a sanity check on the valuation by someone, but then it's absolutely fine to go without a broker because it just complicates the process in many instances. And then if you select a broker, then of course it's important to select a good one. I mean, there are, as in every industry, there are some great brokers, but there are also some where we're like, oh my god. So it's a wide range.
Move on to the interesting topic of how you approach valuations and deal structures, which is probably less spoken about, because so I think initially people think about the valuations kind of first, and also just to say something from my side, when I have less exposure to this than you, obviously not in SaaS M&A, but what I'm seeing is quite low valuations today, and can be as low as like 1.5x like revenue, so on and so forth. So yeah, perhaps you can give us a little bit of viewpoint on not maybe where the market is, but how you approach it.
Yeah. Yeah, so I mean, topic of valuation is really a topic on its own. I always recommend following my colleague Dirk Salma, who publishes one of the best publications, newsletters, but also his LinkedIn posts on exactly that topic quite a bit. And so we work closely together. So I'm probably going to echoing a lot of the things he says. So generally, I think there's a misperception in valuation of what public multiples are, which are public, as the name says. So a lot of founders, they go and check like, okay, what does, I don't know, Snowflake or Salesforce or even some of the smaller players, what do they command? And then they try to fit it in there, and that just doesn't work because it's very different to what private markets pay. And you mentioned 1.5, that indeed would be a little bit on the lower range. We see a lot of transactions around kind of 2x ARR, but we have transactions doing 1x ARR, but we also have gone all the way up to 5, 6x ARR. It really depends on a lot of factors, on growth, obviously. The higher you're growing, the more you can command on profitability, because at the end of the day, a buyer like SaaS Group, we have to also finance a deal. We have to gain back the capital over time. So we have to get to profitability somehow. And if, as a founder, you always need to ask yourself, if you haven't gotten the company to profitability in many years, you like, why should someone else be able to do this then? And so you might be selling just for a 2x ARR, but 2x ARR means at 25% profit margin, this is an 8x EBITDA. And 8x is kind of a reasonable number. Again, if you look at EBITDA multiples, so profitability multiples, you also be anywhere between, I would say, 4x and maybe 10x, or a little bit more. It really, again, depends on growth and a lot of other factors, but 8x is reasonable. It means like it takes 8 years for the buyer to get the money back, and that's actually pre-taxes. So the real amount would be more, or the real time would be more. So it's not abnormal, but it's definitely a wide range depending on a lot of factors.
What about deal structures? Because often I would imagine, so correct me if I'm wrong, it's not 8x ARR or 8x EBITDA and 100% cash up front and the founder leaves. Often there is going to be some earn-out period, but I think it just depends. I think there's
depends.
Yeah.
So there are always components on how you can increase the valuation, because valuation is only one factor. Basically, the main rule is if you're willing to share risk, and as a founder, and put your money where your mouth is, in terms of you're proposing, oh, this business will grow 30% for the next 3 years. If you're like, okay, it's going to be growing like this, and I'm willing to do the work, and I'm willing to commit to this, then that's a very different story than just presenting a plan and, oh yeah, I think this will grow 30%, but I'm not committing to it and I'm not willing to work for that. Then of course you can command a lot higher valuations if you are committing. Also, if you are willing to do what is called a vendor financing, if you don't want all your money on day one, but you want some money maybe in the second year, in the third year, by stretching things out, you can also command a higher valuation. Of course, that comes with its own risks. You need to do your own DD on how creditworthy the buyer is, brings other complications. You can do share deals. I would say even more complicated, because you need to really buy into the valuation of the buyer. So, but all of those things, they kind of work together. And so it's worth actually, and for that, it's, even if you don't have a broker, I think it's very much worth having an experienced person who can guide you through this process. So I'm actually a big fan of working without a broker, but with an advisor in the background who just helps you through those things.
Finally, just regarding this topic, what advice, and I'm sure there's lots, but what specific advice would you give to founders that are considering an acquisition?
So you mean an acquisition to be on the acquiring side, or?
Yeah, so if, let's say they're not on market, right, and or they have like an offer on the table, like I guess kind of like what advice when they're considering doing that beyond what we've already discussed would you give? Like what are maybe the most critical things when thinking about like an offer or selling your business?
Yeah. Okay. So, I mean, apart from the valuation side, I think I would recommend to really do your due diligence on the buyer. By the way, the same on the investor. If you consider getting an investment, an angel investment or VC investment, do the same thing. Kind of, this is a long-term relationship with an investor. Really find out who are those people. Are you comfortable with them? Do reference calls with other founders. So it's one thing we always offer at SaaS Group. We're like, okay, you can call any of the 20 founders from whom we bought the business. You can and should do a reference calls, and we might recommend one or two where we think it's a good fit or it was a very similar situation. But I would really encourage that because like this is a trust thing, and at the end of the day, you're selling where you've put your all your life in for the past couple of years. You want your team to have a good home. You want your customers to have a good home. Also, you want to be there in 5 years, still have this company on your LinkedIn profile. When you click on it, you don't want to go to a 404 page. You want to have this business thriving. At least that's, I feel like this. To me, it's been always super important as a founder. I feel like, for example, I founded Cedo, as I said, and I've exited the company over 10 years ago, but I'm still always cheering for them when they sell domains and where they're on top of the charts, of the domain sales charts. And it makes you proud as a founder if your company continues on. And that's how we're acquiring companies at SaaS Group. We want the founders to continue to be proud of their businesses. 5-10 years later, we preserve the name, we preserve what made the company strong in the first place. Sure, we'll make some changes, but always with best intentions. We're also operators. We're not treating the businesses as spreadsheets. We're really treating the businesses as sustainable, great businesses and growing them further. And I think that's, to your question again, I think that's, founders should find out what will happen after I left.
Just quickly, I know I said the previous one was the last question, but I'm just sort of curious, once you have that LOI through to actually getting the transaction done, what percentage or, would you say like majority, minority of deals actually like fail during that stage as you go through some like DD, to actually get the deal done?
So in our case, we have I think over 80 or 90% success rate after LOI, but that's rare in the industry because we treat LOIs as a handshake agreement. We know there are also some buyers who basically put out an LOI to get information to kind of appear serious. And there are some advantages to the strategy as well, but we think sometimes it's borderline ingenuine, and we prefer to really do our homework before the LOI, the main homework, and the DD should just be a confirmatory DD.
80-90%. That's very good. So good stuff there. Let's move into the quickest fire round, Tim. So let's know what one thing has moved the needle the most for you in your career.
I think it's always this being open for in my career, always one thing has led to the next thing. And for me, probably the one thing that's moved the needle every time is kind of being open about certain problems which appear in one business and solving them myself in a way. And that usually made a good business. And those were always better than the ones where I was just looking at some general trend I didn't really understand. Those were my failures. To make this a practical example, for example, the way I started the AdBlock company was that at Cedo, we were a big ad company. And we were like, oh shit, there is a percentage of traffic that's basically eaten up by ad blockers. And so we're like, okay, we need to do something about this, and there needs to be some middle ground for publishers, and that's how we then used AdBlock Plus as the nucleus for the world's biggest ad filtering company. And yeah, so if I look back at my career, really one thing always has led to the next one.
What's the best advice you've ever received?
Funnily enough, it's I still remember this from a business professor in university who always said, like, there is no good advice. It's like there's like the best advice is really no advice. If the people giving advice knew what they were doing, they would not be just giving advice. So it's really just making your own mistakes and figuring things out on your own. And to me, that's, at the end of the day, the best advice.
Seeing that advice quite a lot these days. What about biggest failure you've made, lesson learned?
Biggest failure was probably in my ad blocking business, not paying enough attention to communication there. We had we were really transforming an industry and messing with some of the big guys, and I think we underestimated the effect on communication, and the fact that something is right didn't mean that we communicated it properly. And so really thinking, okay, how do others perceive this, shaping the story, and being proactive with communication to the broader stakeholder group. And that landed us in deep shit for a while. But I think that's, if I recall this, that's probably the biggest lesson learned. Yeah.
What about, I mean, if there is one, hardest thing about selling a SaaS business today?
Well, the hardest thing is that it's so easy to build a SaaS company these days, which is good because, you with no code tools and putting anything together, you have a great ecosystem now, and we're part of this ecosystem. But it also makes it so easy, meaning whatever you do, there are like dozens, if not hundreds of competitors. So the actual go-to-market is always the hardest thing, and constantly improving everything because competition is always just one click away.
And finally, what is your favorite book on business or business book, and why?
So let me recommend two things here. One is I'm reading it now, I'm halfway through, but I already think it describes quite well on how SaaS Group operates with a very independent model. It's a book called Humanocracy, distinguishing from bureaucracy. And with Humanocracy, they describe very autonomous teams. We at SaaS Group, we also pride ourselves a lot on the freedom of the teams and the way to operate. And I'm always struggling to try to keep bureaucracy and top-level bureaucracy out as much as possible. So this book really resonated with me. Again, I'm halfway through, but I already know it's got to be one of my favorites. But last but not least, to also kind of close the loop with your opening remark about the weather, I do want to recommend. It's not really, it's part business or part, but it's also it's a novel. So it's an interesting mix of a business and a fact-based book and novel, and it's The Ministry of the Future, and it's a book. It's a science fiction, quote-unquote science fiction book on how climate change influenced the world, playing just 5 or 10 years into the future. So not really long-term science fiction, but really kind of what happened, how then this Ministry of the Future changed things. And I was deeply impressed by this book, and I can very much recommend that as a starting read also on how could the world look like in about 10 years if we don't do anything, but also on a positive note, how can we change it? And yeah, Ministry of the Future, definitely one of my favorite books.
Awesome. Thanks for sharing that. Haven't heard of either, but I'll be adding them to the list, and a grateful closer there as well. Thanks for that, Tim. So as we come to the end of the show, Tim, you've been a great guest. Where can people find you and SaaS Group if they want to reach out online and either talk about something that they've heard on the podcast, or maybe they want to sell their business and get some advice and speak to you guys specifically?
Sure. Yeah. So SaaS Group, saas.group is always a great starting point. We have a lot of resources there. We also have a great podcast run by Anna. Dirk has a lot of information there. Our head of origination, a lot of kind of the topics we talked about, M&A, evaluations and stuff. He published a lot of stuff. stuff on that. Then myself, LinkedIn is great. Just add me, contact me. You do need my email address for this. I think there's some LinkedIn protection mechanism, which is super easy. tim@saas.group. You can also shoot me an email. I'll answer every email personally. Really like to connect with SaaS founders out there. Just shoot me an email.
Awesome. Well, Tim Schumacher, thank you so much for being a great guest. I think in 9 years of running the SaaS Revolution Show, I think this might be the first episode we've ever done on exiting your SaaS business.
Okay, wow.
Which is pretty interesting. So thank you so much for sharing that and going deep. Really appreciate it. Thank you so much, Tim Schumacher.
Thank you.